Imagine buying one Bitcoin at $60,000 and selling it at $50,000. You'd think you made a $10,000 loss, right? But what if I told you you might actually owe taxes on a $50,000 gain? That's a $50,000 loss in your pocket and a tax bill that could be over $10,000. This is the crypto tax trap that many investors fall into. The first concept to understand is tax lots. When you buy crypto, each purchase is considered a separate tax lot. Let's say you bought one Bitcoin for $30,000 in January and another Bitcoin for $60,000 in June. If you sold one Bitcoin in December for $50,000, which tax lot do you think you should use? Most people would use the June purchase, resulting in a $10,000 loss. But the IRS says you can choose which tax lot to use, so you could use the January purchase, resulting in a $20,000 gain. One takeaway from this is to keep track of your tax lots to minimize your tax bill. Another concept to understand is wash sales. If you sell a crypto asset at a loss and buy it back within 30 days, the IRS considers it a wash sale and disallows the loss. For example, let's say you bought Ethereum for $3,000 and sold it for $2,000, resulting in a $1,000 loss. If you bought Ethereum again for $2,500 within 30 days, the $1,000 loss would be disallowed. To avoid this, you could buy a different crypto asset or wait 31 days before buying back the same asset. One takeaway from this is to be careful when selling and buying back crypto assets to avoid wash sales. The third concept to understand is long-term capital gains. If you hold a crypto asset for over a year, the gain is considered long-term and is taxed at a lower rate. For example, let's say you bought Litecoin for $100 and sold it for $500 after holding it for 2 years. The $400 gain would be considered long-term and would be taxed at a rate of 15% or 20%, depending on your income level. One takeaway from this is to hold your crypto assets for over a year to qualify for long-term capital gains. The final concept to understand is tax loss harvesting. This involves selling crypto assets that have declined in value to realize losses and offset gains from other assets. For example, let's say you have a $10,000 gain from selling Bitcoin and a $5,000 loss from selling Ethereum. You could use the $5,000 loss to offset the $10,000 gain, resulting in a $5,000 tax bill instead of a $10,000 tax bill. One takeaway from this is to consider tax loss harvesting to minimize your tax bill. To avoid the crypto tax trap, you need to keep track of your tax lots, which could save you $10,000 in taxes. You should also use tools like TurboTax or TaxAct, which can help you navigate the complex world of crypto taxes and save you $5,000 in taxes. And you should consider using a tax loss harvesting strategy, which could save you $20,000 in taxes. Thanks for watching, and don't forget to subscribe to our channel for more crypto and finance content. In our next